Hi, my name is Steve Zeiger. Over the past several years, we've been asked to educate members of NAPAC, the National Association of Estate Planners and Counsels, STEP, the Society of Trust and Estate Practitioners, over 30 local estate planning councils, over 10 FPAs, the Practicing Law Institute, the CFA Society, and we've been speaking about the fiduciary era for life insurance. We've had so many requests for the presentation, we decided to put together an educational video so you can have a copy of the presentation and you can have our verbiage in the background. And now's actually the perfect time to educate fiduciaries on the proper decision support material for life insurance, because on October 20th, 2022, the New York State Court of Appeals constitutionally affirmed Regulation 187, the nation's first client's best interest regulation. And interestingly, when New York State first proposed Regulation 187, agents in New York State sued the Department of Financial Services to overturn the regulation. The regulation requires the use of care, skill, prudence, and diligence that a prudent person would utilize to justify costs, and I'll explain what those costs are, the reasonableness of performance requirements, and assess the risk of underperformance. A little bit of housekeeping before we begin. If you have a question, you can email me. My telephone number is on the screen. If you'd like a copy of our Trust and Estates article, simply send me an email. We're happy to send it to you. And if you'd like a research report at no cost, again, simply email us or call me on my phone. It doesn't mean we're doing business together. If you have a request, it simply means you'd like to learn more. We're going to start off with a little quiz, and here's how the quiz works. Let's pretend we have a 50-year-old male who lives in the state of New York, but they can live in any state, and they'd like to buy $10 million of insurance and endow the contract at age 120. Doesn't matter what type of policy you're thinking of. They think the insurance company can earn 5.5% on their money, which is not guaranteed. And they want an insurance company with ratings that are in the top 10% of all insurers. Let's take a look at what insurance company A has to say. So they offer a $10 million contract with an annual premium of $114,000. The IRR at life expectancy age 85 is 4.64%. Then we have insurance company B. Insurance company B, they have an annual premium of $124,000, $10,000 more than insurance company A, and their IRR at age 85 is 4.24%. So which contract do you think most people would choose? And when I give this presentation live, everyone says choose insurance company A. Why pay $10,000 a year more for no additional benefit? So on the next slide, we're going to look at the internal costs. And we can see that insurance company A, the company that charges $114,000 a year, their internal costs are $8.5 million between age 50 and age 100. Insurance company B, they're the company that charges $124,000 in premium. Their annual costs are $5.4 million. So by choosing insurance company B, you actually save $3.1 million. You might need to spend $10,000 a year more. In some cases, you won't need to spend anything more. But the importance of this is to discuss these internal costs. By saving $3.1 million, the insured or the client or the policy owner can have $3.1 million more cash value, present value adjusted, or $3.1 million more death benefit, present value adjusted. And it's not just me saying that we should look at costs. FINRA says that we should look at costs. The Society of Actuaries says that we should look at costs. Also the Uniform Prudent Investor Act and the New York State Department of Financial Services. But we'll go through that as we get deeper into this educational presentation. First, let's talk about the current situation. Life insurance is the most tax-favored financial services product. The death benefit is income tax-free. The death benefit can be estate tax-free when it's properly designed. The cash value grows tax-deferred. There's no tax each year. And there are non-taxable loans and non-taxable withdrawals. So it sounds like a perfect product. But the reason why things can go wrong, let's take a look at the fourth bullet. Relative to clients' expectations, it can be a poor performing asset type. And the reason is because no one's looked at costs, and if the costs are too high, performance will decrease. And life insurance It's integral to planning, but it's the last and it's the most neglected financial services product. People buy it, they stick it in their drawer, whereas with their other assets, they might review those every day or every quarter. The charges are difficult to understand and range by up to 80%. Let's talk about what I mean by that. So imagine we have this $10 million contract, and the average costs at age 50 are $6 million in costs. There's a 40% variance on that $6 million. So one company is going to charge $2.4 million more. One company is going to charge $2.4 million less. A total swing of $4.8 million. But if you don't look at costs, you won't know whether you have the one that's $4.2 million more or $4.2 million less. Actual performance is difficult to ascertain. And what I mean by that is, if I asked you, how did your mutual funds do last year? You might say, I was up 6.2%. And if I said to you, how did your insurance do last year? For the past 15 years, I've gotten lots of shoulder shrugs. And also when it comes to costs, no one really knows what costs they are incurring. If I asked you how much your Vanguard fund costs in management fees, you might say 4 or 5 basis points, depending upon the fund. If I asked you how much your mortgage cost, you might say 4.1%. And if I asked you how much your life insurance cost, again, a shrug of the shoulders. So first of all, let's start off by talking about what actually are life insurance illustrations. So life insurance illustrations are depictions of the non-guaranteed elements of a life insurance contract over a period of years. And let's take a look at me, for example. If I'm 50 years old, the life insurance illustration goes from age 50 to age 120, which means there are 70 rows of numbers, and there are also 5 to 10 columns. So you're immediately looking at thousands of numbers, and then we're looking at those numbers at 0%, 5%, 10%. So it's really impossible to look at the numbers to make a decision, and it's impossible to look at one illustration and compare it to another illustration. So in addition to all of that information, there are dozens of disclaimers and footnotes, and then the client signs an attestation of understanding. And I doubt they really understand it. So life insurance can be summarized as this. There's a cost of insurance charge, which is the charge for all of the other people that have passed away. There are policy expenses for actuarial design and marketing and distribution. And then there's the earnings on the contract. So regardless of the type of contract that it is, the formula is the cost of insurance charge plus the expenses minus the earnings equals the premiums. So as far as life insurance illustrations, what are the legitimate practices for the use of the illustration? 1, you can look at how the policy works. 2, you can figure out under lower or higher returns or interest assumptions or investment performance, what will the impact on the policy be? 3rd, you can run what-if cash flow scenarios. But the questionable practices that we see quite often are cost competitiveness. It's impossible to determine the cost competitiveness of a policy by looking at the illustration. And later I'll show you how to do that correctly. Performance reasonableness. Impossible to figure out from the illustration, and I'll explain that in a couple of slides. Risk appropriateness. Again, impossible to figure out from the illustration. So in other words, it's not a representation, it's not a forecast, it's not a prediction. So now we're going to talk about guidance from New York State Department of Financial Services, FINRA, the Office of the Comptroller of the Currency, the Society of Actuaries, the CFP Practice Standard, the Uniform Prudent Investor Act, and Morningstar. So first, let's talk about Regulation 187. Regulation 187 is the nation's first client's best interest regulation, and it uses fiduciary wording, care, skill, prudence, and diligence of a prudent person, looking at cost, performance, and risk. Who does it apply to? It applies to residents of New York, even if the advisors are in another state. It applies to former residents of New York if the ILET is domiciled in New York. It applies to ILET trustees who are in New York, even if the ILET is domiciled elsewhere, and it applies when the financial services advisor is in New York. So ethically, Regulation 187 applies in every state. It requires considering only the interests of the consumer in making a recommendation, It must reflect the care, skill, prudence, and diligence of a prudent person. And the advisor must prominently disclose in writing any limitations in the ranges of the policies that they offer. Meaning if they're an agent of one particular insurance company and they can only present from that insurance company, they need to disclose that to the client. Let's talk about why Regulation 187, why it ethically applies in every state. So imagine that we have an attorney, an accountant, an RIA, a trustee in the state of Arizona, and they have an insurance matter, and they speak to an insurance advisor in the state of Arizona. That individual has no requirement to work in the client's best interest. Therefore, the attorney, the CPA, the RIA, the trustee, they should either A, contact an insurance advisor in the state of New York who complies with Regulation 187, or they should simply give a list of the requirements to the agent in Arizona and have them work under a client's best interest formula. Let's talk about guidance from the National Association of Insurance Commissioners. And I think the National Association of Insurance Commissioners are kind of a funny organization if you look at what they say. So in 1995, their goals were to ensure that illustrations do not mislead purchasers of insurance. 20 years later, in 2015, they noticed a lack of uniform practice resulting in illustrations that use an apparently identical crediting rate yet illustrate different rates. So 20 years later, insurance illustrations are still misleading. Let's talk about what FINRA has to say. So in FINRA Rule 2210D, comparisons must disclose all investment objectives, the costs and expenses, because not doing so would be misleading. So what typically happens when I speak to an insurance agent, they say, well, if I'm presenting a universal life or a whole life or indexed universal life, that doesn't fall under FINRA Rule 2210. And I say that's actually correct. However, by not disclosing the investment objectives, the costs and expenses, it's still a misleading presentation, even though it doesn't fall under that FINRA rule. FINRA Rule 2210-2C, it's inappropriate to compare an insurance policy with any other product based on hypothetical performance. Yet, most of you probably have seen presentations where it's an Excel spreadsheet of two policies side by side. That's really forbidden. Let's talk about the Society of Actuaries, the final report on the task force on life insurance, and they say illustrations should not be used for comparison purposes because doing so is fundamentally inappropriate. So in several slides, I'll show you how to benchmark life insurance so you're not comparing the illustrations side by side. The Department of the Treasury, the Office of the Comptroller of the Currency, they oversee bank trust companies, and they say the illustrations have a high degree of fluctuation. And what that really means is they're just unreliable. The Uniform Prudent Investor Act has two requirements that I'd like to speak about today. The first one is a duty to diversify. So periodically, we see an individual that has $10 million, $50 million, $100 million of coverage with one insurer. And they would probably never buy a $100 million bond from one issuer. They would want to diversify. And the same thing is true for life insurance. There's a duty to diversify unless it's prohibitively expensive to do so. Now let's talk about what the Uniform Prudent Investor Act says about costs. A trustee may only incur costs that are appropriate and reasonable in relationship to the asset. And here the asset is life insurance, and the associated costs are the cost of insurance charge, the policy expense, a premium load, and perhaps a cash value-based wrap fee for variable products. Let's talk about the Center for Economic Justice. And I'm going to read the quote, "The current illustration regime permits insurers to illustrate investments in ways not permitted for any other type of investment, a faulty infrastructure that consistently produces misleading information to consumers." So we're hearing this word misleading kind of often. So now let's talk about litigation regarding life insurance. And there are two cases that I think are important to discuss today. The first case is Naccio versus Goldman Sachs. And probably you remember the name Naccio. He was chairman of Quest Communications. And you might recall that he was arrested on running a $3 billion fraud. He spent 4 years in jail, and his fine was, I think, $60 million. Well, Well, Nacho purchased a life insurance policy from Ayco, a division of Goldman Sachs, among the smartest financial minds on the planet. And the advisors at Ayco breached their advisory duties, so they didn't look at some of the things that we've been speaking about today. And Joseph Nacho won a $14.1 million judgment against Goldman Sachs Ayco. And what's very interesting about this case is usually I'm presenting to attorneys and accountants and RIAs, and I say to the attorneys, how much credibility does a convicted felon have in court? And they always reply, none. So imagine this, a convicted felon sues Goldman Sachs Ayco, among the smartest financial minds in the world, and wins a $14.1 million lawsuit. So most of our clients and most of your clients are not convicted felons, and that really teaches us why we should be careful in how we present life insurance. Let's also speak about Cochran versus KeyBank. So Cochran versus KeyBank was a very interesting case because it was the first adjudicated lawsuit regarding a life insurance policy owned by a trust under the Uniform Prudent Investor Act. So the facts of the case are as follows. Cochran owns $4.5 million of general account product. So that's either whole life, universal life, or an annuity. Later, Agent Robertson suggests a change to an $8 million variable life contract, and Grantor Cochran moves to the $8 million contract. Years later, Agent Robertson communicates to Grantor Cochran that if the stock market goes down, Cochran can lose his entire death benefit and all of his cash value. Cochran responds that he doesn't want his legacy subject to the stock market, and in addition, he can no longer afford to pay premium. So Agent Robertson suggests a $2.5 million paid-up contract, and KeyBank hires an independent third party to interview Grantor Cochran and the trustees at KeyBank Trust Company, and they opine that this transaction makes the most sense for Grantor Cochran. They move ahead with the transaction. Cochran is 53 years old, so he should have a life expectancy of another 30 years. And I don't remember if the exact words were the case where he unexpectedly died or he died unexpectedly, but 6 months later, he passed away. And the family lost the difference between $8 million and $2.5 million, a $5.5 million loss. They sued KeyBank under the Indiana Uniform Prudent Investor Act, and the court decided that because KeyBank went to an independent third party that had no financial stake in the outcome, that was considered a safe harbor under the Uniform Prudent Investor Act. So Trust and Estates magazine asked us to review the case using independent research, and I'll show you how we did that in several more slides. But what the independent research showed was the internal costs of the $8 million contract per $1 million of death benefit were lower than the internal costs of the $2.5 million contract per $1 million of death benefit. Had they simply moved the death benefit from $8 million to $5 million and transferred the cash value from a stock market-based fund to a money market fund, they could have had $5 million of coverage going forward. Now, many insurance agents, when they hear the story, they say to me, "Hey, Zeiger, we don't really like this independent research model so much. You just ruined the sale for us." And what they fail to see is that when you are transparent, when you disclose all costs, when you use independent research, people will beat a path to your door because you're helping them achieve a better outcome with all of the information available. So what are the ethical alternatives to illustration comparisons? First, there should be no illustration comparison in the trust or client file. You should insist on detailed expense pages. I'll show you what those are in 2 or 3 slides. You can get those from the insurer. You can put them together yourself in Excel, or you can buy independent research, which we will give to you at no cost. At a minimum, you want to compare costs and performance separately. I'll show you how to do that in a few slides. And then we want to benchmark the life insurance. Benchmarking is well established and common in the financial services industry. You're familiar with the S&P 500 index. You're familiar with the Dow Jones Industrial Average, the MSCI. And now I'd like to make you familiar with life insurance industry benchmarks from Veralytic. In addition, illustration comparisons are inconsistent with your duty to exercise care, skill, prudence, and diligence. So now, before we go through the illustration, I just want to talk about the feedback that we get from attorneys and accountants and RIAs. Typically, they say they're uncomfortable with the lack of transparency in the life insurance business. They're also frustrated with the inability to determine which illustration is going to lead to a better outcome. They're also worried that they are fiduciaries and they're referring business to non-fiduciaries or individuals who don't act under a client's best interest standard. So let's take a look at this illustration. In the left side, you can see that the planned premium is $181,000 a year. And then you'll see this blue section that says the end of year guaranteed assumptions at 2%. And on the right side, you'll see the end of year non-guaranteed assumptions at 4.95%. And what we're going to do is we're going to look at years 24 and 25. And we're going to do the only math that you can do in a life insurance illustration. First, we're going to subtract this year's cash value, $1.828 million, from last year's cash value, $1.76 million, and we see that there's a difference of $51,934. So we had a gain, an actual gain of $51,934. And then we want to look at what was our expected gain. So our expected gain is $1.828 million times the 4.95%. We expected a gain of $90,516. So the only math that's left to do is to subtract those two numbers. So if we expected $90,000 and we only received $51,000, the only conclusion we can make is that we had an expected cost of $38,582. So just write these numbers down really quick. 1.828 million cash value, expected gain of $90,000 at 4.95%, and expected cost of $38,000. On the next slide, we request from the insurance company the detailed expense and the detailed performance for this policy. So we see the same $181,000 premium, and now we know that every year there's a premium charge of $32,588. There's an admin charge that starts at $33,000 and rises to $49,000 by age 30. And then there's a column, how much is credited. Let's look at the 25th year, the same year that we were looking at on the previous slide. The cash value is $1.828 million, and the insurance company credited $348,000. Well, we determined that 1.8 million times 4.95% was $90,000. So therefore, a $348,000 credit is a 19% rate of return. Now, I'm not here to discuss whether the insurance company can credit 19%, and I'm not here to discuss whether they can't credit 19%. I'm simply here to say that the insured, the policy owner, the grantor, the fiduciary advisor, they all think this is a conservative product run at 4.95%, when in actuality, it's an aggressive product, and this year run at 19%. And just so you see that I'm not picking one strange year out of the 30 years, let's look at the 30th year. When the cash value is $2.03 million, the amount credited is $580,000. Quick math, a 25% rate of return. Now, I know what you're thinking. Steve, this is probably the only misleading illustration out there. So I'll show you another one. In this example, in the red box, you can see that the illustration is based on a conservative 5% rate of return. And what we've done is we've gone to the 11th year when the cash value is $116,776. Then we've requested from the insurance company an additional report. We want to see what's the cost of insurance charge, what is the policy expense, what is the premium load, and what is the interest credit. And you can see in the red box, the interest credited was $16,556. Well, quick math shows that's not 5%. It's actually 14%. And again, I'm not here to discuss whether they can pay a 14% rate of return or whether they can't pay a 14% rate of return. I am here to say that everyone thinks this is a conservative illustration when it's actually, it needs to do an aggressive return in order to illustrate at the 5%. So we're going to start speaking about independent research. When we want to determine if an investment is a good choice, we might look at Morningstar, a household name. When we're buying a new car, we look at J.D. Power. When we're buying a new toaster or microwave, we look at Consumer Reports. And I'm going to walk you through all of the independent life insurance research that is available. But first, I want to talk about our why. You've probably heard of Simon Sinek, and when I watched the Simon Sinek video, it made me understand what I was actually trying to do. So I believe in challenging the status quo. I want to change the life insurance industry. I believe in thinking differently, and I want to use a prudent process for selecting life insurance, not hypothetical illustrations that don't lead to a better outcome. This prudent process helps you choose which policies to purchase and which policies to replace or retain. It results in a better decision-making, and consumers and grantors have better outcomes. Let's take a look at independent research for life insurance. So the first slide that we're looking at starts off by talking about FINRA Rule 2211, communications with the public. And FINRA Rule 2211 says that an illustration may use any combination of assumed investment returns up to and including 12%. So we have one of the tools within Veralytic is sort of an algorithm that can figure out what's the insurance company actually crediting. And you can see in the first one, it's crediting a 14.33% rate of return when the regs say 12% is the highest. But what I found most interesting is the bottom chart. So in the bottom chart, the insurance company has a crediting rate of 4.95%. That's what's disclosed. But deep in the numbers that no one would look at other than a little insurance nerd like me, there's an undisclosed bonus of 4.56%, which means the ultimate rate of return in the illustration is 9.51%. So the consumer thinks, and the agent thinks, and the fiduciary thinks this is a 4.95% rate of return. This multi-billion-dollar insurance company can earn 4.95% of their money, when in actuality, it's an aggressive or moderately aggressive 9.51%. The next slide is simply a Morningstar report on a variable life sub-account. And again, if you need these reports, we have an unlimited subscription. We're happy to send you whatever you need. EBIX provides life insurance research. For example, if you're wondering what percentage of an insurance company's bonds are non-performing, EBIX has that research. If you want to know what percentage of an insurance company's bonds need to be replaced in the next 10 years or the next 5 years with bonds that might pay a lower rate of return, EBIX has that research. Now we're going to put together everything we learned today. We're going to use benchmarking for life insurance. We're not going to compare insurance illustrations side by side. We're going to use independent research. So let me tell you about this matter before we start looking at it. I walked into an attorney's office. He explained to me that he specialized in estate planning and asset protection. And he said, I saw on LinkedIn that you were involved in the insurance business. He said, by coincidence, I'm working with a client who has about $13 or $14 million of insurance, and he wants to buy $50 million. And I immediately lit up inside, thinking I was going to be invited to work on this case. And he said to me, but I already have somebody from Guardian, somebody from Mass Mutual, someone from NFP, somebody from Northwest, somebody from MetLife. He said, I have wall-to-wall illustrations, so I really don't need your help on this case. I said, well, you might want to include me. He said, why? And I said, well, has each agent or broker told you that what they have on the table is the best for the client? He said, yes. And I said, and are you able to determine what is best? And he said, no, we're actually not able to do that. So I said, in my model, what I do is I go to up to 4 independent providers of life insurance research, and they opine on what is best compared to the life insurance industry benchmarks. He said, that sounds interesting. We'll include you. So what we presented to him was a research report, multiple research reports. I'm going to walk you through 2 of them. So there are only 5 areas of life insurance suitability. The first one you're probably familiar with, which is the financial strength and claims paying rating of an insurance company. And the way the research works is the ratings from Moody's, Standard & Poor's, Duff & Phelps, AM Best must be in the top 10% of all insurers in order for the company to receive a full star. So MetLife is the company that we're evaluating at the moment. Their ratings from all of the major rating agencies are among the top 10%. They receive a full star. The next area of suitability is cost competitiveness. Cost competitiveness looks at the internal cost, the cost of insurance charge, the policy expense, the premium load, and compares them to industry benchmarks. And then the research looks at the premium and compares those to the benchmarks. And I'll show you this graphically in 2 minutes. I just want to give you the lay of the land. The next area is pricing stability. So pricing stability is an algorithm that can figure out, will an insurance company need to raise their costs? And if they do, performance will go down. And this algorithm looks at reinsurance treaties, and it looks at the costs for the insurance company for the past 20 years. So for example, if these costs in an illustration are substantially lower than the costs have been for the last 20 years, that might be a red flag that this insurance company is trying to buy business and then they're going to increase costs. MetLife does not do that at this age in this health class, so they win a full star. The next area is relative policy value. So this is looking at the cash value of the policy compared to cash value of all other peer products. And MetLife's cash value is among the best, so they win a full star. And again, we'll show you this graphically in a minute. And lastly is the historical performance of the underlying assets. How does MetLife invest their money? Because that's what determines the performance of their policies. So MetLife's performance has been average, so they win half a star. This is a 4.5 star policy. Let's take a look at this graphically. We're going to concentrate for the moment in the box in the middle on the top row. And you can see there are 3 blue bars. We're going to look at the one on the most extreme left first. So this is the costs that this policy is incurring. So just like you can have a Vanguard fund and Vanguard charges you 4 basis points, MetLife charges you 16 cents per dollar of death benefit on a present value basis. If we go one column over to the middle column, we see that the average insurance company charges 23 cents per dollar of death benefit. And that means that this particular insured is incurring costs that are 6 cents below average. Multiply 6 cents times the $12 million in the upper right, and you'll see exactly how much they're saving compared to the average policy. The bar on the extreme right within the middle box, that's for non-institutionally priced products. We're not looking at that bar. And then we're going to look in the box all the way over on the right. There's a green bar and a blue bar that we're going to concentrate on. So the green bar shows that this policy owner is being charged $260,000 a year in premium. And the blue bar shows that other insurance companies charge $360,000 a year in premium. So this is looking like a pretty good policy. MetLife's ratings are among the best. Their costs are lower than their peer group. Their premiums are substantially lower than their peer group. And let's look at their cash values. You can see that the cash value grows today from approximately $1 million to $16 or $17 million in the future. That's the green line that's going up. And all of the other companies, they run out of cash. Why do they run out of cash? Because their costs are higher. So at this point in the presentation, the attorney and the client said to me, Stephen, we told you that there were 12 other insurance brokers involved in this case. And the 12 other, you're the outlier. You're telling us to keep this MetLife product. Everyone else is telling us to get rid of it. And I said, look, I could convince you to get rid of it, and I'd make $500,000 doing so. But 3 independent third parties are telling you this policy is phenomenal. Its costs are low, its premiums are low, its cash values are high, and its ratings are excellent. The only way to replace it is one of those misleading illustrations that I showed you a couple of slides ago. I said, let's take a look at your next policy, and you'll see how well the research works. So this is the same insured, different insurer. This is New York Life. And again, just so you know, there's nothing wrong with New York Life. They're a great company. Their slogan is the company you keep. But the policy owner immediately said, Stephen, if MetLife is charging me 16 cents per dollar of death benefit on a present value basis, why is New York Life charging me 32 cents? And I said, well, there's only one answer, and that is they're ripping you off. And he said, well, how are they ripping me off? And I said, well, when you purchased the policy, they told you that they had paid a dividend during 2 world wars, and they have. At the time that you purchased this policy, they'd paid a dividend during 1 pandemic, and now they've paid a dividend during 2 pandemics. But what they didn't tell you was that at your age and your health class, their costs are, you can see, higher than everyone else's, and the cash value in green that you're required to keep in this policy is substantially higher than everyone else would charge you. In fact, you can buy this a $1.1 million face amount with an increasing death benefit and put $200,000 in your pocket. He said, that's pretty interesting. Let me see if I understand this. I want to buy $50 million of coverage in total. Can I buy $50 million at the 16 cents that MetLife is charging me? I said, yes. I go into the Veralytic research and I find out which is the company that has the highest ratings, that charges 16 cents per dollar of death benefit on a present value basis, has high cash values, etc. He said, great. So what you're saying is let's get rid of this New York Life policy and let's buy a total of $50 million of coverage at 16 cents per dollar of death benefit. Simple, easy, transparent, no hypothetical illustrations, and we've used benchmarking like this individual is familiar with on its investments. Let's take a look at another case. So we have a male age 35, and this time we're going to compare a general account benchmark versus a variable account benchmark. The client has a MassMutual whole life policy. The internal costs are 16 cents per dollar of death benefit on a present value basis. And just to teach you a little bit more about the research, the best available rates and terms are approximately 40% less than the Veralytic benchmark. So we know that 60% of 14 cents, which is the middle column, we should be able to find coverage at approximately 8 cents per dollar of death benefit. And we can also point out what the potential savings are. 8 cents times $10 million in death benefit, we should be able to save the client $800,000. The client decides what do they want to do with the $800,000 of savings. So on the next slide, what can they do? They can increase their cash value, present value adjusted, by $800,000. They can increase the duration of the policy, or they can reduce the premium and buy the same death benefit, or they can buy more death benefit. Looking at the research, we found that Prudential charges 8 cents per dollar of death benefit on a present value basis. And that's the second bullet. In the first bullet, we can see that they were paying 16 cents per dollar of death benefit on a present value basis. So to sum up this exchange, they were paying $180,000 a year for 19 years for $10 million of annually increasing face amount at a charge of 16 cents per dollar of death benefit on a present value basis. What we proposed to them was pay the same $180,000 a year for 19 years for $25.7 million of death benefit and be charged 8 cents per dollar of death benefit on a present value basis. So you can see in the middle bar, in the middle bars, we've lowered their cost to 8 cents. You can see that the Veralytic benchmark for variable life products, which here is at 10 cents, and for the general account product, it's closer to 14 cents. And now you can see over on the right that the premium has remained $180,000 a year, and we can see the death benefit is now $25.7 million guaranteed. Before it was $10 million a year increasing. And now, since we're not allowed to compare life insurance illustrations side by side, we're going to show you them one at a time. So here in the left column, it says the new premium, this is for the in-force policy, is $182,000 a year. And then the death benefit you can see is $10 million. And by life expectancy, which is outlined in blue at age 80, the death benefit's grown from $10 million to $24 million. What we showed with the Prudential policy, on the left, same $182,000 a year in premium. The guaranteed death benefit is $25.7 million, and then the projected death benefit starts off at $25.7 and may grow over time depending upon policy performance. We illustrated at 7%. So in this case, the attorney did not have in their file a prudent process for selecting the policy. Yet that attorney, because they were the trustee, they were actually liable for the difference between the $10 million current face amount and the $25.7 million that we proposed. Had they had a prudent process for selecting that $10 million in coverage, that would have been fine. But since they didn't have that, they are actually liable. 35-year-olds don't die that often, but between the age of 35 and 80, sometimes they do. Now let's compare a 52-year-old female with a general account product with the variable benchmarks. So we can see the client is insured by Northwest Mutual Whole Life. They're being charged in blue 26 cents per dollar of death benefit on a present value basis. And we've learned that we can beat the Veralytic benchmark by approximately 40%. The death benefit of this contract is $3.8 million, and it grows annually based on a non-guaranteed dividend. So how can the policy owner use any cost savings that we find? A, they can increase their cash value. B, they can increase the policy duration. C, they can reduce the premium and buy the same death benefit, or they can keep their premium the same and buy more death benefit. This policy owner wanted to buy more death benefit. So we go into the Veralytic research and we see that at this person's age and health class, we can buy coverage at 17 cents per dollar of death benefit on a present value basis. So now we're going to talk about how this policy owner wanted to utilize the savings. Let's walk through the facts again. The current plan pays $19,648 a year for life for $3.8 million of coverage with Northwest Mutual. This is an annually increasing face amount, and they're being charged 26 cents per dollar of death benefit on a present value basis. So option one, which they did not want, was pay less premium and buy similar death benefit. Option two, buy more death benefit. So they were able to purchase $7 million of coverage guaranteed for the same $19,648 premium for life, and they exchanged the $947,000 of cash value to the new policy. They're being charged 17 cents per dollar of death benefit on a present value basis. So let's look at the Veralytic information. They're now being charged 17 cents per dollar of death benefit. They only beat the variable account benchmark by a small amount, but they beat their current general account benchmark by a lot. They were paying 26 cents. Now they're paying 17 cents. As far as premium, the premium appears to be $70,000 a year, but it's not. And I'll explain that in 2 minutes. It's the current premium due of $19,648 plus the transferred cash value. But let me show you this graphically so you can see that it's legit. So here's the Northwest Mutual illustration. On the left side, the new premium is $19,648 a year. The guaranteed death benefit today is $3 million, and it grows to $3.6 million by age 80, life expectancy. And then there's a projected death benefit that goes from $3.8 million to $6.5 million. So on the next slide, you can see we have the same $19,648 premium on the left. We have a guaranteed death benefit of $7 million. So if this individual passes away, tomorrow, almost like Cochrane did, they currently have $3 million. We've increased it to $7 million. And then we can see in the projected death benefit, if we earn 7% on their money, by age 80, the death benefit can continue to grow on a non-guaranteed basis. I hope you enjoyed today's video. We learned how to see the guidance from FINRA, from the Society of Actuaries, from New York State Department of Financial Services, from adjudicated lawsuits. We learned how to request or look at the detailed expense pages that show the policy expense, the premium load, the cost of insurance charge. We learned how to use independent research. We learned how to compare, instead of comparing life insurance illustrations to life insurance illustrations, we learned how to follow what we do in investment land. We compared the detailed expense pages to the life insurance industry benchmarks. You probably have, questions because this is a brand new area. So if you have a question, simply send me an email or give me a call. I know it doesn't mean we're doing business, simply means you have, more questions. If there's someone in your network who you'd like to introduce me to, just send us an email. If you'd like a copy of the Trust and Estates article on the Cochran case or an article on the Joseph Naccio case, again, just send an email. And if you'd like any of this research, again, there's no cost. We have an unlimited subscription. And just like if you called up your RIA and said, can I get a research report on this particular fund? They don't send you a bill for $500. It's the same thing here. You can obtain the research from us at no cost. When you send us the detailed expense pages, you can redact the client's name. We wouldn't have any interest in contacting them. Again, we want to make you shine. And again, thank you very much. And next is my contact information. Again, thank you for taking a look at this video. If you liked it, let us know, your aha moments, and feel free to forward it to your peers. Thank you and have a good day.